Welcome everybody to International Trade Live. My name is Joseph Clarke and I'm the editor of International Trade magazine. In this interview session, I'm joined by Casterman, the founder and managing director of Casterman Advisory, which advises early stage fintechs that are active in trade financing, payments and digital assets, as well as the CEO of Trade Finance Distribution Initiative. Andre, thank you so much for joining us. First of all, could we begin by learning about your history in the industry and how you got to where you are today?
Hello, Joseph. Great to join your stage. And indeed, my journey in the industry has been all around the financial technology, what we now call fintech. I've been in that industry for 32 years, starting really in the multi-bank community through Swift as an employee for 24 years, and then joining the startup space by becoming an investor in startups and advising startups in terms of working with industry stakeholders, in particular the banks. So that has been really my focus for 30 plus years, focusing on bringing advanced technology to banks in order for them to become more efficient and grow their business.
Okay, and for those who don't already know, what is the Trade Finance Distribution Initiative?
So in 2018, with one of my fintech investments, we'll talk about Tradeteq a bit later, we set up the Trade Finance Distribution Initiative, recognizing the need for creating a community of stakeholders, financial institutions, but also technology and legal firms, law firms, a community to establish trade finance as an investable asset class. It was an investable asset class back then for a very few top banks who had transformed back then on a proprietary basis the trade asset class as investable for institutional investors. However, that has not been democratized to the wider banking community. So after four years, indeed, we have been able to demonstrate that technology can be democratized, brought as a software as a service offering to smaller institutions, smaller banks, but also smaller players active in trade finance, and helping them take advantage of capital markets liquidity. So we have now not only a community established, but also a number of advanced players, large banks, smaller banks, and institutional investors, making sure that liquidity can go from back and forth, depending on the need from the clients of the banks, which are usually, in this case, the corporates and SMEs.
And you mentioned that you have achieved that over the past 4 years. What do you think has been a key player in getting the banks to recognise that technology has such a vital role?
Yeah, banks are continuously looking at automating processes, because by automating processes, you can actually reduce cost, remove frictions from manual processes and potentially errors from manual processes. So there is a continuous quest to digitize, to automate, to standardize. In a similar way as you can look at the car industry, where car production is also highly automated. So it's the same logic in banks. However, banks have another dimension to consider, which are the regulatory requirements. And more regulators are driving most of the agenda, and we'll talk about later about the Basel regulation. And this has driven also the need for banks to basically work with liquidity providers, such as pension funds, credit insurers having also liquidity to invest, and other large liquidity providers, and better manage their balance sheet. So really the challenge for the banks is automation and balance sheet management in order to drive down the cost of processes, but also the cost of capital when financing their own clients.
Yeah, I think technology is definitely a challenge, not just for banks, but in most, if not all, sectors. Within the context of international trade, what kind of businesses do you think most benefit from the TFDi?
So we are very focused with TFD initiative on the distribution space. So a distribution space means that a bank is financing an SME, a corporate, but then that's the origination space, that's a primary space as we call it. But then in the secondary space or distribution space, the bank itself will further get liquidity from an institutional investor or another bank. So there is this distribution space that is bringing liquidity from those who are not necessarily in trade or who don't have access to those SME clients and corporate clients, but who want to help, but they're helping in the background. The goal of the TFD initiative is to bring more liquidity to those originators, the banks. It could be non-bank originators like supply chain finance platforms or B2B platforms supporting trade flows. However, the ultimate beneficiaries of TFD initiative are the SMEs. Because if there is one big issue in the industry when it comes to financing global trade, it's definitely the 2 trillion SME funding gap that has been measured over and over by industry stakeholders like Asian Development Bank, which is very well documented. And that's really the community of the target, the ultimate beneficiaries of TFD initiative, those SMEs, whether they are funded by banks, factoring companies, supply chain finance platforms, or B2B logistics platforms and B2B e-commerce platforms. At one point in time in the transaction, they need liquidity. Liquidity to fund production, liquidity to pay invoices, basically with different trade finance techniques, there is a way to bring this liquidity at minimum risk for the bank. And those are the transactions that the TFD initiative aims to fund. But we always go via the originator or the platform managing the transaction. TFD initiative doesn't aim to attract all those SMEs in the community because the SMEs will go and choose their preferred partner, the bank or factoring company or a B2B platform where they run their business. But the liquidity has to come to those players in order to fund the SMEs. Now, you could ask, are the pension funds active in TFD initiative interested in SMEs? Because you have huge pension funds and very small SMEs. There's a big gap in terms of profile between those players. But indeed, there is appetite because in the middle, someone like a bank or a platform is managing the transaction, servicing the transaction, checking that the transaction is compliant, and this is a key role of those originators we work with as part of TFD initiative, who are bridging those two worlds: the big institutional investors with huge liquidity that they find interesting but also hard to allocate to individual transactions, but those originators in the middle are the ones who will allocate the liquidity to individual transactions in the best possible way, meaning taking into account the AML requirements, anti-money laundering requirements that are applicable around the world. So SMEs are the ultimate beneficiaries, and institutional investors like this space because actually this is those are the transactions which bring the better yield to those investors. If you fund blue chip companies with very low risk, your yield on the individual transactions will be very limited. Whereas if you fund SMEs in short-term trade flows, the yield is much higher because of the risk profiles of those SMEs. So we have a good formula here that we are already serving today with some members of TFD initiative in production, and definitely this is what we are demonstrating through various testimonials and events through the TFD initiative.
I think it definitely sounds like something that would be, for the SMEs in particular, a complex process, and something that would require help from an initiative such as this one. With regard to international trade, the complexity of it and the high costs associated, what do you think are the main reasons for those?
Yes, over the years, and certainly since 2008 and the global financial crisis, the banks have been more and more impacted by new regulations, and the policymakers have been focused on, first of all, fighting financial crime, so money laundering, typical, and also increasing the resilience of banks, supporting the financial system. So with those two impacts over the last 15 years, basically 2008, 15 years coming onto banks, banks have had to become much more focused on a particular segment, blue chip companies or SMEs in some cases, or some specific geographies. And they have de-risked, that means they have moved out of some markets because the risks were too high or the volumes of activity was too low in order to cover fixed costs, to run compliance operations, and to basically assess the risks with regards to some geographies or some segments. So more and more banks have become more focused on particular segments. They have moved out often. The large banks have often moved out of the SME market or emerging market corporates, exporters. And we have seen the entrance of new players because the demand from SMEs is still there and growing in terms of funding their trade activities. So new players have come into the market. We can call them alternative lenders, non-bank lenders. And sometimes those are logistics platforms coming from the trade logistics space. It could be B2B e-commerce platforms that are adding funding as part of their trading processes. And more those SMEs are finding new ways, basically, to get the funding they require. And those new players funding SMEs are the ones we target, definitely, as part of TFDi initiative, because we do have as members those institutional investors that want to bring liquidity to those alternative lenders so that they can fund those SMEs. So more focused by each category of player, top banks, local banks, supply chain finance platforms as new lenders, is the name of the game here. And the community basically is growing. Trade is not just about the top banks anymore. It used to be, but it's not just about that. Trade has seen more open account trade techniques coming into the market, like supply chain finance, democratized to the SME space as well through those alternative lenders. And this whole change in the market that is really driven by the global financial crisis and much regulation that came following that event of 15 years ago, but still applicable and still impacting the market, is what we are taking definitely into account in order to connect the different players through TFDi initiative.
And what are Basel III requirements, and what strain are they putting onto the banks?
Yeah, the Basel III requirements are indeed an excellent illustration of those regulatory decisions coming out of the 2008 global financial crisis. In simple terms, I would say it's all about increasing the resilience of the balance sheets of the banks. When they are taking risks, they have to put capital aside. There are complex formulas to determine the level of capital required. But basically, the more risky clients the banks fund, the more capital they have put aside. So from a use of capital perspective, trade finance can be very expensive in terms of balance sheet capacity when funding some corporates, which is why, as I said just a few minutes ago, banks have pulled out of some of those segments or categories because it became too expensive from a balance sheet perspective to fund those corporates. Now, there are two ways to indeed react to that, to those capital Basel III requirements. Either you accept the additional capital you have put aside, and you basically, as a bank, you distribute, again, through TFDi initiative, you distribute the transactions that are taking too much space on your balance sheet in a way. You distribute those to institutional investors, so that you reduce your capital use on your balance sheet. You release capacity and you can fund more corporates, or you just say, I don't want to fund those corporates anymore because they are becoming too expensive, and I leave that to local banks or new entrants like those alternative lenders. But Basel III requirements continue to be expanded in the market. There are revisions, the requirements become more stringent, and it is impacting heavily the attitude of banks with regards to financing trade. But at the end of the day, when a bank leaves a particular segment or particular geography, there are new players. This is creating new opportunities for players. What we want to do is reach out to those players, and some could be definitely your members, your readers, which are active in B2B commerce, logistics, and which are at one point in time growing so much they realize that those transactions they manage in the corporate to corporate space could require funding, and they could embed funding into B2B platforms. We can do that as well through TFDi initiative and the liquidity that our members bring, in particular the pension funds and other types of institutional investors.
You've just sort of picked up on something that I wanted to ask as well, regarding our readership, and in particular SMEs. You recently published an article in International Trade magazine in which you talk about how banks suffer from low margins and therefore they're not as interested in smaller businesses. So what advice would you give to SMEs in this context, given the extra difficulty of the fact that banks aren't interested in those smaller organizations?
Yes, I mean, they're getting less and less interested in those small organizations because indeed of the regulatory impacts on their balance sheets, and also KYC, AML requirements, where filtering those transactions is required in order to comply with anti-money laundering regulations. So the cost of processing is increasing, the cost of capital is increasing, and basically it becomes really not as interesting as before to fund those SMEs. So what advice I would give to those SMEs is to look for alternative lenders. There are more and more alternative ways to get funding, not from typical banks, classic banks that are extending payment services, FX services, investment banking services, but from specialized players that are not banks, but they are still usually supervised financial institutions, and they usually have developed the technology to fund invoices on an individual level, and those platforms are taking risks on SMEs, but in a way that is quite mitigated, because they will use techniques like supply chain finance, approved payables techniques, where the buyer has to approve the invoice before the supplier, the SME suppliers, gets the funding. In this case, the risk is quite low because the platform gets an irrevocable payment undertaking from the buyer, so committing to pay at due date, and the number of days between the approval of the invoice and the due date offer a funding opportunity. Those platforms usually don't have their own liquidity. They rely on institutional liquidity. It could be banks in the background or institutional investors in the background, extending that liquidity to those funders. But the advice really to SMEs is look for alternative lenders that are focusing exclusively on this function. They won't offer payment services, FX services, so the bank is still critical for those services, but the risk of funding has to be mitigated. It is good for SMEs to be creating their own panel of funders, so that when one can't sustain the demand, the SME can rely on the second or third source of liquidity to fund indeed trade instruments like payables and receivables.
And moving, therefore, now more into the solutions as opposed to the multiple risks that we've just discussed. How is technology helping? What are the main ways in which technology is helping international trade finance?
Yes, definitely there are multiple sets of technologies now, and trade has always been paper driven, because national laws require some documents to be exchanged, produced and exchanged on paper, like bills of lading in sea transportation, or bills of exchange and promissory notes. But laws are changing. More and more technologies are used, again, to automate processes, to remove manual handling of like checking documents. More and more this is automated. In the area of TFDi initiative, what we are using technology to bridge the banking space, so those who are frontlining corporates and SMEs, and extending liquidity to those end customers. And we are bridging that banking space with the capital market space. Now, those two spaces have very different ways of working. And with TFDi initiative, we have developed the technology to transform payables and receivables into notes. Notes that are capital markets instruments that institutional investors are used to handle across multiple investment classes, handling potentially billions, trillions of dollars on notes across multiple asset classes. And in trade, that was missing. This automated bridge between the banking space serving corporates and the institutional investors having the liquidity. So we have built technology through Tradeteq that is basically automating the transfer of assets, like invoices being funded from the banking space to the capital market space. And of course, if we transfer the asset, we transfer the money back at the same time. And this is the money going, for instance, from a pension fund to a supply chain finance or e-commerce platform and down to the SME. And that's how technology is being used there to automate this, because we're working at very granular level. The amount of invoices we fund on a daily basis is huge and can't be handled on manually in Excel. This is impossible. The cost would be too high. The errors would be too numerous. We need to automate this. And that's what TFDi initiative has delivered, so that someone can take advantage of this complex transformation engine without having to develop it, just being able to subscribe to it, to pay as you go, in order to distribute your assets to institutional investors.
Yeah, and you've just mentioned Tradeteq and also IFTA you're a board member of as well. Could you tell us a bit more about those? How do they work and what are the main benefits for businesses?
Yes, so basically Tradeteq is the software as a service hub of TFDi initiative. So this is the technology hub that demonstrates through actual client use that trade finance can be investable in a democratized way. That means any type of originator, any size, a new alternative lender, or an established small factoring company or a larger bank can use the Tradeteq hub to start distributing in an automated way invoices being funded to institutional investors. And the Tradeteq hub has become, in the trade space, really the most comprehensive platform for distributing trade assets to institutional investors, because sometimes you need a note structure, a repackaging, a securitization program. Sometimes you need an outright assignment. Sometimes you have a credit insurance policy. So depending on the type of transaction and requirements of the market, you have different mechanisms to basically distribute trade risks and assets. And that's what Tradeteq focuses on. Tradeteq will not go to the SMEs to fund the SMEs, to onboard the SMEs. We onboard only the basically originators of that want to distribute to institutional investors, and we onboard institutional investors as well. Tradeteq is the main hub, but that doesn't mean it's the only technology, because within the bank you have booking systems that have to feed the Tradeteq hub with the transactions that need to be funded and need to be exchanged and between the various Tradeteq clients. And recently we have expanded into the blockchain space in 2021 by basically being able to tokenize also trade assets, because some institutional investors are looking at tokenization rather than notes issuance. And this is another technique basically to repackage and securitize transactions. Tokenization is a growing topic. It's still very early days, but we see regulators are also very active on that technology track. With ITFA, International Trade and Forfeiting Association, this is a banking community of trade finance providers, banks, supply chain finance platforms, alternative lenders, some factoring companies, and also credit insurers and institutional investors. And this is a community where through which we as an industry talk to regulators mainly. We engage with regulators to calibrate new policy developments, such as, for instance, the digitization of negotiable instruments. We were recently involved with the UK to change the 1882 Bill of Exchange Act, which is a kind of historic moment. 150 years later, we are transforming an act to enter the 21st century with a digital option. This act got royal assent in July and is effective as from September 2023. So that has required working with UK Parliament, and this is being done through ITFA as a banking association. ITFA is not a commercial entity. Tradeteq is the commercial entity with supporting the TFDi initiative community.
And through your work with the three, with TFDi, Tradeteq and IFTA, how have you found that businesses are adapting to the increasing technological approaches to finance, such as, for example, the Tradeteq platform?
Yeah, I mean, businesses adapt indeed, because banks discover new options that are off the shelf. Because those techniques, the distribution space has existed for a few decades, but only the top banks could make use of distribution techniques because they were expensive to implement on a proprietary basis. Like securitizing trade assets required millions of investment before the first transaction could be achieved 10 years ago. It is only now with the Tradeteq becoming an off-the-shelf hub, which we call software as a service, that we have democratized this practice. Now, the democratization offers opportunities even to the smaller originator. And we see alternative lenders like supply chain finance platforms. I can give a few names like Accelerated Payments or Mercor, getting more and more into indeed the full trade digital experience for their clients. So having a nice platform to offer liquidity to their clients in a digital way, to distribute trade assets to institutional investors in a digital way. So the most advanced implementations are usually done by the smaller institutions because they are more agile. They are more open to new options, and they appreciate the fact that they don't have to make this investment themselves. This capital investment themselves, they can really start plugging into different technologies on the origination side, on the distribution side, plugging into or embedding those technologies and start making use with a minimum investment. And that's what they really like. So new alternative lenders really some have been created over the last 12, 18 months, so very recent, but they attract SMEs and mid-caps because they offer new ways of working at very attractive rates. Now, we elevate those new role models in the industry through TFD initiative and through ITM indeed as well. The goal is also to help the top banks, and top banks are definitely very well aware about what is happening, what are the new options. But indeed, given the complexity of the organization, they need a bit more time to move into production. But we already got very two examples of top 5, top 10 global banks that are taking advantage of TFD initiative developments at the Tradeteq hub to automate their distribution to institutional investors. And those are the ones we feature on our event, the Investor Day of October 2023, where the institutions share their implementations and testimonials.
And finally, Andre, I'd just like to ask what your predictions are for the next, let's say, 5 or 10 years, with regard to both the complexities that we mentioned at the beginning of this interview, and also the role that technology will continue to have for financing purposes.
So my dream is really to get the funding and the TFD initiative processes backed by Tradeteq as closely as possible to the SMEs who require funding. And this is achievable by embedding the funding APIs or the credit insurance APIs into trading processes supported by B2B platforms. And the B2B platforms are definitely part of your community and your readership. And basically, this has been done on the retail side. When you're booking a Eurostar ticket, for instance, you can embed credit insurance easily. You just click on a button. But in the B2B space, we could embed funding of invoices at the point when the invoice is triggered on the B2B platform. So bringing funding as closely as possible and really embedding funding and the TFD initiative APIs into the trading platforms where the SMEs are basically issuing invoices and purchase orders and invoices and so on, and getting the two worlds to be much more integrated is what will help also the SMEs get funding when they need it. So more embedded finance into is what we are definitely working towards.
Well, thank you very much, Andre. It's been an incredibly interesting talk, and I'm sure that our viewers will have taken a lot of insight away from this, just as I have. So, yeah, thank you very much, and we look forward to seeing how the next few years take shape with regards to these matters, and also to talking with you again in the future.
Thank you, Joseph. Pleasure being here.